Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need.
Exactly.
Today, we're plunging into the latest earnings call from Manhattan Associates, covering their second quarter 2025 performance. That call just happened July 22nd.
That's right. And our mission, like always, is to pull out those vital signals, give you a sharp, efficient overview.
Yeah? What's their performance looking like? What are the strategic moves, the outlook? What does it all mean for you, really?
And honestly, if you're looking for a company that's, not just treading water, but actually doing pretty well in this environment, Manhattan Associates, well, they delivered a genuinely better than expected Q2. Strength on their top and bottom lines. Pretty solid execution.
Absolutely. So let's unpack those numbers first because, that's where the rubber really meets the road.
Okay.
Total revenue for the quarter landed at $272 million. That's a solid 3% increase year over year.
Right. But the real standout, I think you'd agree, was cloud revenue.
Oh, definitely. It didn't just grow, it surged, up 22% to hit $100 million.
Yeah, a big milestone. And this isn't just, random growth. It's that strategic pivot to subscription playing out.
Shows that shift is really working. Predictable, scalable.
Exactly. Now, while cloud was shining, it's worth noting services revenue did dip a bit.
Okay, what happened there?
Down 6%, came in at $129 million. Management pointed to some customer budget constraints.
Pushing projects out.
Yeah, shifting work into future periods. They're being pretty cautious about it. Those time and materials contracts have flexibility, and the macro picture is still uncertain.
Right, something to keep an eye on. But despite that caution on services, their RPO, the remaining performance obligation, that looked incredibly strong.
It really did. Ended Q2 at $2.01 billion.
Wow.
Which is, a robust 26% increase year over year and up 6% just from Q1.
So for folks maybe less familiar, RPO is basically their pipeline of contracted future revenue, right? Money they expect from existing deals.
Precisely. So that points to really solid, predictable revenue visibility down the line.
And that visibility is helped by their average contract length, still holding steady.
Yeah, still healthy. Around 5.5 to 6 years on average. What's interesting is some customers are opting for slightly longer implementation ramps.
Meaning it takes a bit longer to recognize the revenue?
Kind of. They recognize about 38% of that RPO as revenue over the next 24 months because of that. But, and this is key, management isn't just accepting it. They're actively working with customers to try and speed up those deployment timelines.
Yeah.
Faster deployment means recognizing that revenue faster. Helps the top line.
Makes sense. Okay, let's shift to profitability. That story looked pretty compelling too.
Very much so. Adjusted operating profit hit $101 million, and the adjusted operating margin was 37.1%.
Which is up, 210 basis points year over year.
Yeah, 2.1 percentage point jump. It clearly shows that operating leverage kicking in as the cloud business scales up.
Right. As those high margin cloud subscriptions grow, more just flows straight to the bottom line.
And you see that directly in the earnings per share. Adjusted EPS, $1.31. That's up 11%.
And GAAP EPS.
Also up 9% to 93 cents. Good numbers all around.
What about cash flow?
Operating cash flow was $74 million in Q2, up 1%. Now, there's a small footnote there.
Okay.
The Q2 growth looks a bit flat only because collections were unusually strong in Q2 last year. So the comparison is tough.
Okay. So year to date is a better picture.
Exactly. Year to date, operating cash flow is $149 million, and that's up a healthy 17%.
Good context. And the balance sheet, you mentioned solid earlier.
Rock solid. Finished the quarter with $231 million in cash and, impressively, zero debt.
Zero debt. Nice. And they're returning cash to shareholders, too.
They are. Put $50 million into share buybacks in Q2. That brings the year-to-date total to $150 million.
And the board's still supportive.
Yep. They just approved another $100 million replenishment for share repurchases. Signals continued confidence.
Okay, so the financials look strong. Let's shift focus a bit. What about the leadership and the kind of core advantages driving this?
Yeah, good question. The call actually kicked off with the executive chairman, Eddie Cable, giving some real praise to the new CEO, Eric Clark.
Oh, yeah. How's he doing?
Apparently very well. Cable highlighted a smooth first 160 days, a successful momentum conference, and obviously these excellent Q2 results.
That's good to hear.
And Cable also announced his own plan. He's transitioning away from executive management by January 1st, 2026. He'll become chairman of the board then.
Okay. Sounds like a well-managed succession.
Seems like it. And it kind of reinforces their message about strong fundamentals. They kept emphasizing continuous innovation, their superior platform, the product portfolio.
Right, that whole supply chain commerce ecosystem they cover. It's not just numbers, it's the underlying business.
Exactly. And that growth isn't just happening by itself. They've got strategic levers they're pulling.
Like what?
Well, focusing on new customer wins, obviously, smart cross-selling across their unified product portfolio, and crucially, converting those legacy on-premise customers to the cloud.
And is that strategy working? The win rates?
It's still looking really good. Over 70% win rates against their top 5 competitors. Same as Q1. That's a serious edge.
Wow. And I think you mentioned new customers were a big part of the recent bookings.
Yeah, that really jumped out. Over 70% of the new cloud bookings in Q2 came from brand new logos.
70%? That's huge.
It is. And new logos make up about 35% of their current pipeline. Now, they expect that to maybe normalize back towards a third over time, but it shows real market traction right now.
And it's broad traction too, right? Across different industries?
Totally diverse.
Yeah.
Retail, grocery, life sciences, industrial, tech, airlines, 3PLs, you name it. They highlighted specific Q2 deals like a big global logistics company, a grocery wholesaler, and even a luxury goods retailer, making that key switch from on-prem to cloud.
That's interesting. Think about that in this economy where lots of companies are tightening belts.
Right. Their last 3 bookings quarters have been their best ever.
Yeah.
All during this challenging macro period.
So it really underscores how essential their software is seen, not discretionary.
Exactly. Companies see it as a competitive differentiator.
So to keep that momentum going, they're investing more in sales and marketing.
Strategically, yes. A key move was promoting Bob Howell to Chief Sales Officer. He brings like 20 plus years of supply chain and sales leadership. Seems like a smart internal promotion.
Putting experience at the helm globally.
And they're adding new strategic sales leaders too, specifically focusing on POSS, that's point of sale open store, and TMS, transportation management system.
2 big markets for them.
Huge markets. They already have leading solutions, but there's massive potential for more share gains. They're literally adding more feet on the street.
Hiring aggressively then.
More sales talent hired in Q2 than in any quarter in the last 10 years. And they're pulling people from competitors, Blue Yonder, Oracle, Mad Mobile.
Wow, okay. They're serious about taking share. What about partnerships?
Also expanding there, their solutions are now on the Google Cloud Marketplace.
How does that help?
Reduces friction. Makes it easier for customers to buy and deploy. Their biggest Q2 deal was actually influenced by that channel, and the pipeline from Google Cloud is growing.
Interesting channel strategy. And Shopify too.
Yep. An expanded partnership there. There's a connector app now for Manhattan Active Order Management right in the Shopify App Store.
Goal being easier adoption for retailers.
Exactly. Quicker adoption of their store and point of sale solutions, making integration smoother for those big enterprise retailers using Shopify.
Okay, let's switch gears to product innovation. This AI stuff sounds pretty significant. Agentic AI.
Yeah, this is where it gets really exciting, I think. Manhattan Assist, their existing AI, is already handling hundreds of thousands of inquiries, configuration guidance, that sort of thing. But the key update recently is that customers can now upload their own documents, training manuals, process flows.
So Assist can give answers specific to that company's operations.
Exactly. Tailored answers for their specific DC or store makes it way more valuable. Truly bespoke.
That's clever. But there's more coming this fall, a new platform.
Right, the new agentic AI platform. And this isn't just Q&A AI. This is about AI acting as purpose-built agents. Digital assistants, basically.
Doing what?
Automating tasks, making real-time recommendations. Imagine a labor optimization agent suggesting, right now, who to reassign in the warehouse based on workload.
Okay, real-time optimization.
Or a store selling agent giving personalized tips based on a shopper's history, both online and in-store. It's about making the human workers faster and smarter.
More efficient on the front lines.
Exactly. But maybe the coolest part is the Agent Foundry.
Foundry? What's that?
This lets customers build their own AI agents within the platform.
Seriously? Build their own?
Yeah. They can tweak existing Manhattan agents or create new ones from scratch using APIs. These agents can even interact with other agents, even ones outside the Manhattan platform.
That level of customization, that sounds like a potential game changer for adoption and stickiness. Tailoring AI to unique needs.
Could be huge. And it ties into their whole unified platform message, which seems to be paying off really well.
How so? The cross-selling.
Exceptional cross-sell results. That message of functional and technical unification is clearly resonating. Get this. Over the past 5 quarters, roughly 80% of customers buying their transportation management also bought or already had their warehouse management.
80%. So they're seeing the value of having it all integrated.
Definitely. Faster ROI, more efficiency, strategic advantages, and they're backing it up with investment. Dedicated engineering team just for unified features and a new product council to co-create with customers.
Smart. Okay, bring it back to the investor context. Given all this, they raised their guidance for the full year.
They did. Strong Q2 and first half led to raised outlooks across the board. Total revenue now guided to a midpoint of $1.073 billion.
And margins.
Adjusted operating margin guidance up significantly to a midpoint of 35%. That's up from 33.25% before.
Big jump. And EPS.
Also raised quite a bit to a midpoint of $4.80. These aren't small adjustments. Signals real confidence.
There was a detail about the tax rate, though. Increasing.
Yeah, a bit nuanced. The annual tax rate is going up to 22.5% from 21%. It's because of a U.S. tax law change around accelerating R&D deductions.
So higher tax rate means lower profit.
It creates about an 8-cent headwind to EPS in the second half, yes. Slightly lower reported profit per share, but it actually lowers the cash taxes they'll pay this year. It's expected to boost operating cash flow by about $30 million in 2025.
Okay, so a small EPS dip on paper, but more cash in the bank. Got it.
Exactly. And management seems very confident they can keep that cloud growth humming along at 20% plus for multiple years.
What gives them that confidence?
Several things. That big RPO backlog we talked about gives visibility. Solid bookings and pipeline. Their market, the TAM, is expanding. Plus all those sales initiatives, specialization, partnerships, new hires.
Right, the feet on the street.
And critically, the renewal cycle starts picking up steam in 2026, especially for warehouse management.
And renewals mean opportunity.
Big opportunity. They expect renewals at higher rates because customers are using more DCs, more users. Plus, it's prime time for cross-selling those newer products. TM, planning, the AI agents, and potential price increases too.
So they're prepping for that renewal wave now.
Actively.
Yeah.
And working to speed up current deployments to pull revenue forward where possible.
Makes sense. And you mentioned earlier those strong bookings lately came despite the macro headwinds.
Yeah, really remarkable. The last 3 quarters, best ever bookings, all during this tougher environment, speaks volumes about the product demand.
How's the on-prem to cloud conversion going? Is that accelerating?
It's a major focus. About 20% of on-prem customers has started the journey. Management definitely wants to speed that up. It drives both cloud and services revenue.
And those big ERP migrations everyone talks about, still helping.
Still creating tailwinds, yeah. When companies overhaul their big ERP systems, it often opens the door for Manhattan Associate solutions too. Creates pipeline.
Okay. And you mentioned they're trying to make implementations more efficient with AI and automation.
Right. The goal is to shorten timelines and lower costs. That makes their solutions more accessible, maybe even to slightly smaller Tier 2 companies.
Expanding their addressable market, essentially.
Effectively, yes.
Yeah.
And helps customers get to that ROI faster.
So looking ahead to that big 2026-2027 renewal wave, they sound prepared.
Very much so. They're building out a global structure led by Bob Howell, specifically to maximize growth from renewals, not just pick the box. They're measuring 18 months out, having cross-sell talks way in advance.
Proactive. What about CIO priorities generally? Are companies still investing in supply chain tech?
The message was clear. Forward-leaning companies are not holding back. Recent events just reinforced how mission-critical this stuff is. They see it as a differentiator.
But maybe some caution on deployment speed?
Some flexibility there due to the macro, yes. But the commitment to invest seems strong, especially among leaders. Supply chain resilience is still top of mind.
And lastly, marketing. You said they're looking for a CMO.
Yeah, an open search is underway. Seems like a signal they intend to really ramp up investment in marketing, boost awareness, build on that sales talent they're bringing in.
Okay, interesting times ahead for them. Which brings us to
our This Is Not Financial Advice segment,
where we toss out an outrageous but plausible trade idea for experienced investors only.
All right, so given everything we've discussed, Manhattan's unique spot, strong balance sheet, those strategic investments, here's a thought.
Lay it on us.
Consider a long play on MAH shares. The conviction here is that the market is seriously underestimating the boost they could get from that new agent foundry and the cloud partnerships.
So the idea is management's being too conservative.
Potentially, yeah. On that 20% plus cloud growth target. And maybe that slightly cautious services outlook hides some real upside.
Because of the AI agents and partnerships driving faster adoption.
Exactly. Think about it. Customers building their own AI agents, using Agent Foundry. That drives incredible stickiness, maybe even usage-based revenue down the line. Combine that with easier onboarding via Google Cloud and Shopify.
You think it could lead to exponential growth, outstripping the guidance?
It's the outrageous but plausible part.
Yeah.
The argument is that this isn't just a solid 20% growth story anymore. It's potentially a re-rating story.
A re-rating?
Yeah.
Meaning the market values it differently.
Right, valuing it more like a top-tier SaaS company, deserving a higher multiple because of that potential for accelerating sticky, high-margin revenue.
And the catalyst would be?
That 2026-2027 renewal cycle, that's when all these cross-sell opportunities for the AI, the unified platform, that's when it could really hit. It's a conviction play on technology adoption accelerating.
Okay, definitely food for thought there.
Yeah.
So let's quickly recap.
Yeah. Manhattan Associates delivered a very solid Q2. Beat expectations, strong cloud growth, impressive new logo wins.
They're making significant strategic bets, sales talent, that agentic AI, key partnerships, all while keeping the fundamentals strong, zero debt.
And they raised their full-year outlook, reflecting confidence and solid execution in what's still a pretty dynamic environment.
So this deep dive really shows a company positioning itself strategically, leveraging innovation, expanding its reach. Looks like they're playing for long-term growth.
Seems that way.
Now, remember everyone, this is absolutely not financial advice. Always do your own thorough research. But what stands out to you from this call? How do these moves shape your view of their path forward? Anything new you might want to dig into after this?
Thanks for tuning into the deep dive. We appreciate you joining us for this look into Manhattan Associates.